Hello, my name is Jason Petersen, Head of Wealth at Five Financial. In these uncertain times, Matt and I thought that you would like to hear from BlackRock, the model manager of the iShares strategic enhanced models that you have all invested in. I'm joined by James Waterworth, National iShares Specialist for BlackRock, to discuss these models and more. Jimmy, hello.
Jason, thank you very much for having me here today. We know it's a stressful time, particularly from a health perspective, and we wish you and your loved ones well in the coming months. Moreover, as many of you have questions from an investment lens, that we hope to address today.
Jimmy, before we get into the weeds, can you please tell us a little about BlackRock?
Sure, Jason. BlackRock is a global investment manager and technology provider who helps investors of all types, including some of the world's largest sovereign wealth and pension funds, achieve their financial goals. We were founded in 1988 by our CEO, Larry Fink, who is still at the helm, and are a publicly listed company on the New York Stock Exchange. We manage over 10 trillion Australian dollars as of the 31st of December 2019. That makes us the world's largest investment manager, an extraordinary responsibility. I guess most relevant to today's listeners is our purpose, which is to help more and more people experience financial well-being. We're dedicated to helping our clients, employees, shareholders, and communities achieve financial security, financial mobility, and financial freedom.
Thanks, Jimmy. That latter point resonates quite strong with Five Financial's principles. Changing tack, can you provide a quick overview of the current market environment?
Sure, Jason. I'm not sure about quick, but I'll try to be as succinct as possible. We have a team called the BlackRock Investment Institute, and their view is as follows. Global markets have taken a fright at the scale of potential economic damage wrought by the coronavirus containment measures. They see the economy coming to a near standstill, but expect activity to ultimately return with limited permanent economic damage, as long as authorities deliver an overwhelming fiscal and monetary policy response to bridge businesses and households through the shock. Central banks are preventing the financial system's plumbing from getting clogged and stand ready to do more. Market moves have been reminiscent of the financial crisis, but they don't think it's 2008, as the economy and financial system are on a much stronger footing. They believe investors should take a long-term perspective and maintain benchmark exposure to risk assets. They emphasize portfolio resilience through a benchmark allocation to government bonds, quality equities, cash, and sustainable investing. And for long-term investors, we see significant value being created in risk assets.
Thanks, Jimmy. Now, I preface the next question knowing you or BlackRock doesn't have a crystal ball.
I've got a glitter disco ball. Does that count?
No. So the question is, when does the crisis end?
So markets, according to the BlackRock Investment Institute, will ultimately settle down if three conditions are met. One, visibility on the ultimate scale of the coronavirus outbreak and evidence the infection rate has peaked over the long term. Two, deployment of credible and coordinated policy packages. And three, confidence that financial markets are functioning properly.
Okay, so they're great insights and provide a useful backdrop to now drill into the iShares enhanced strategic models. Maybe before we get into the weeds, I'll ask a simple question. What is a model portfolio?
Model portfolios are no different from other investment portfolios in that they are a collection of securities held to achieve a given objective. However, in contrast to portfolios built from individual securities, such as stocks and bonds, the building blocks of model portfolios are primarily exchange-traded funds, ETFs. A key advantage of this approach is that ETFs enable investors, even those with limited capital, to assemble broadly diversified portfolios at a low cost.
Jimmy, you mentioned ETFs. Would you mind explaining them in a little more depth?
Absolutely. An exchange-traded fund, or ETF, is a diversified collection of assets, like a managed fund, that trades on an exchange, like a share. It blends the benefits of both managed funds and shares and offers investors a simple and cost-effective way to achieve diversification in their investment portfolios. So for example, you can invest in a S&P 500 ETF that tracks the 500 largest companies in the USA, all in one trade.
That's pretty impressive, but how have the ETFs held up with all the recent market volatility?
The coronavirus pandemic has caused significant volatility in financial markets. Global equity benchmarks fell from record highs into a bear market in a matter of weeks. The CBOE Volatility Index, so it's an index which looks at share market volatility, increased to its highest level since 2008. Fixed income markets were impacted by moves in interest rates as central bankers sought to mitigate the virus's economic impact. Market volatility of this magnitude has few precedents within the past century. It's notable that in this environment, ETF volumes have increased markedly as a large number of investors turn to exchange-traded funds to express their views and adjust positions. Several metrics indicate that ETFs have held up comparatively well during the heightened volatility, with investors using ETFs to help manage risk in challenging market conditions. Our ETFs have continued to trade and to date have provided access to liquidity in volatile markets.
That's great. Jimmy, can you just explain what's BlackRock's approach to creating and managing the model portfolios, particularly as it relates to the iShares enhanced strategic model portfolios, which we implement on our clients' behalf?
Thanks, Jason. So designed for Australian dollar-based investors, the iShares enhanced strategic model portfolios were constructed to balance exposures to assets denominated in Australian dollars with the benefits of diversification across domestic and international assets. So a quarterly portfolio rebalance seeks to deliver additional returns over the target benchmark by deviating from the target benchmark asset allocation. The model portfolios seek to optimally balance long-term returns, risks, and costs as per the objective of the 5 risk profiles being conservative, moderate, balanced, growth, and aggressive. We also have the ability to rebalance out of cycle if the situation merits it.
Jimmy, you mentioned risk and return. Can you explain that in more depth?
Absolutely. So BlackRock employs a total performance management investment philosophy in creating and managing our model portfolios. This involves optimizing forecasts of returns, risk, and costs. The return forecast provides the expected payoffs to the exposures in the portfolio and is where we spend most of our time and effort. The wrong return forecast will not add value for our investors, even if we get the risk and cost forecast right. The risk forecast seeks to guide us on the likely fluctuations above or below our return forecasts. Relatively risky assets, such as equities, have a higher chance of returns being significantly above or below the forecasted return compared to, say, government bonds. The risk forecast includes forecasting returns by asset class, and these relationships help us assess potential diversification benefits. Of course, we do have to note that risk management and diversification do not guarantee positive returns.
So we talk to our clients about diversification all the time, but of course, and we know the adage of not putting all our eggs into one basket.
That's perfect. We then look at optimization that solves for the portfolio with the best expected return per unit of risk. BlackRock's proprietary risk management system, Aladdin, provides a risk forecast of all the assets we trade. Lastly, we look at the cost forecast, the expense to the investor of holding each ETF and their cost to trade. We build these costs into our final optimization as penalties to adjust portfolio weight, so transaction costs.
That's a really good point on costs. It's something we're very, very mindful of.
Yeah, and so lastly, in contrast to some other model providers, BlackRock does not use a set and forget approach to building models. We always seek to enhance our forecasting methods, feeding the enhancements through to new and existing models equally as part of our fiduciary duty to act in the best interest of our clients.
This is very comprehensive, Jimmy, and it really speaks, in my view, to your institutional capabilities. Brings me to my next question. You mentioned Aladdin earlier being your risk system. I always thought it was a story about the genie in the lamp. Can you explain your Aladdin a little bit more?
Yeah, sure. So Aladdin is our proprietary risk management system. More than portfolio management software, Aladdin is an end-to-end operating system for investment professionals, such as the team who manages the iShares enhanced strategic models. So it enables them to see their whole portfolio, understand risk exposure, and act with precision. So through the Aladdin platform, BlackRock helps clients navigate volatility and market uncertainty. It's all well and good having a fantastic system. However, we also have a rigorous risk management procedures and controls for the strategy. So regardless of the investment strategy, all of our client portfolios are managed under a single risk management philosophy. We believe that risk for portfolios should be 1, deliberate, 2, diversified, and 3, scale. Moreover, we have an independent team called Risk and Quantitative Analysis Group, RQA, that leads BlackRock's portfolio risk analytics efforts by providing independent top-down and bottom-up oversight. RQA partners with BlackRock's investment teams to ensure that risks in the portfolio are consistent across each strategy with the team's current investment themes and with each client's formal risk constraints. RQA is also responsible for counterparty and operational risk management.
So shifting gears, with COVID-19 dominating the news flow and our lives, how do we think about investing long-term in markets like this?
The extreme sell-off in risky assets since late January is the latest episode that brings into sharp focus the importance of building portfolio resilience in strategic asset allocation, which is a core facet of our portfolio construction process. To be sure, such an approach is no silver bullet. Most asset allocations would have suffered as assets sold off in tandem, yet we believe it offers a good starting point for long-term investors to build on. As we stated earlier, we do not have a crystal ball, so are unable to provide thoughts on future performance, expectations for the iShares enhanced strategic models. If we look back, say, for the growth portfolio to the end of February, the portfolio was up 8% and close to 6% per annum over 3 and 5 years, respectively. We'll publish the March numbers shortly. If we look at equity market returns for March, they were heavily down. For example, the ASX 200 here in Australia was off circa 20%, and the S&P 500 that tracks US equities was off close to 11% in Aussie dollar terms. This will feed through to negative returns in the portfolio, so I hope that helps.
Thank you very much for today's session. It's been tremendous. You've been very generous with your time and insights, and on behalf of Five Financial, I'm very grateful.
Thanks, it's my pleasure, and I'd also like to thank you and your clients for your support, and we wish you all the best in coming weeks and months.
Likewise, Jimmy, thanks very much, and have a great day all.
Thank you.